Crazy new launch prices, can you still make any money or not? In this video, we will deep dive into the current state of the record high new launch prices in Singapore. We'll explore the key factors that contribute to these crazy prices and discuss whether they still present lucrative opportunities for investors such as yourself. Firstly, I'll be talking about the 4 critical factors that affect how housing developers price their units. Secondly, we'll be looking at a couple of case studies in the same vicinity to compare their land costs and also explore the COVID effect on property prices. And if you stay until the end, we will be answering the important question of whether you can still make money in today's crazy new launch market and what you can do to increase your chances of making a profit. So, the first point that we are talking about will be the 4 critical factors that affect how property developers price their units for sale. Now, if you know a little bit about my background, I actually work for a Malaysia developer. So we had a lot of land in Nusa Jaya, which is near Legoland, Malaysia. And we were building luxury condominiums over there. So I was the sales and marketing director, and I was in charge of procuring land, working with the architect itself to design the entire development and including the individual unit layouts. I was also in charge of the landscaping, working with the landscape architects, and also to procure materials for construction. That means I had to fly to various countries to look at materials and select materials, color, everything from which wall is supposed to be painted, what color. I was also in charge of that. So I think I do have the right to speak about this topic. Firstly, what is one critical factor that we know? To me, it's land prices. Okay, so land cost itself, if a developer does not pay a low cost for the land, then every single cent, the cost will still go back to the consumer, which is yourself. Now, if we look at the current market in Singapore, you will notice that recent supply has actually dropped significantly. That means if you look at the amount of new launches that have been coming out, there's no more mega projects like last year or the year before. So what you notice is that there's a lot of developments like Florence Residences, Treasure at Tampines, Normanton Park. So all these huge developments have fully sold, POP starting to hand over keys. So you have to know that these property developers are flush with cash. That means their pockets are very, very fat. And as property developers, what you need to justify to your shareholders, especially listed companies, is land. If you don't have any land to develop, then you don't have any profit potential. So if you look at some listed companies, they have their annual report, they will actually state what land they have, what is the potential number of units, potential profit, and these are the things that will determine whether the company in the upcoming year will be looking at a positive or negative revenue and how much they're going to make. So land cost is a major factor for a property developer, and of course, how many plots of land did they actually have. My point is that when the developers right now, they don't have much land on hand and they have a lot of money, the bids tend to be aggressive for the good plots. But there are other factors that would also dampen what the developer feels is the current market consensus. That means what is the demand and whether or not they will aggressively bid or they will be toned down. So what is an example of desperation of developer? Okay, so I read this to you. Okay, Marina Gardens Lane site, first to kickstart development of the 45-hectare Marina South Precinct. So this one has fantastic sea views and is facing Gardens by the Bay. Okay, CBD area, the views would be fantastic. site can yield 790 residential units plus 8,073 square feet of commercial space near the future Marina South MRT station. So what happened is that Kingsford and consortium partners Obsidian Development and Polarix Cultural and Science Park Investment triumphed the second highest bid by 42%. That means the group headed by Kingsford actually paid $1.034 billion, and it's higher than the second bidder by 42%. This is an example of how desperate the developer is to get land. The reality is that some developers only have money right now and no land. They will pay a higher premium. Of course, we also hope that the developers will be a bit more conservative and not overbid so that the prices won't skyrocket. But there are some developers who will overbid. Okay, so what you can do as a consumer, it's also good for you to look at and find out what are the land cost prices, the break-even point of each development before you purchase that particular property. For the second point, we will be looking at construction costs and the effects of COVID on it. Let's look at this diagram over here. This one is done by Straits Times. This is a very informative diagram that shows you in general what has been happening. Now this is only for 2021, but if you notice right here, things like shipping, freight costs itself has jumped 200%, and even things like building materials steel has gone up by 54%, cement, granite, sand 3 to 10%, concrete is more than 20%, aluminium 59%, copper 81%. So what happened during COVID? If you remember, it also coincided with the Ukraine-Russia war at the same time. Now, when you have a big manufacturing country like China does a lot of steel and concrete. Whole China was locked down. A lot of materials couldn't get out. Majority of the countries were in quarantine, and when you add the fact that Ukraine and Russia was also in war and it affected petrol prices, so petroleum was expensive, and they were also exporters of some raw materials. But in general, when you add all these factors in, plus when workers cannot come in, you have salary was increased by 46%, and this is just like May to December 2021. You haven't even add the 2022 increase. Foreign levy also more or less everything has been going up. So when you see construction costs, you notice that when we were in the COVID lockdown, all the projects were delayed. There was a backlog. It's only after everything was lifted and recently all the projects start to TOP, handover keys. But the reality is that prices have already skyrocketed. Inflation has already set in. Everything from what we eat to what we drink, what we drive, everything also became more expensive. Public transport became more expensive, rental became more expensive, including things like what your property developer costs are to build a project and deliver it to you. So everything went up. So that is the reality, and we have to understand that the developer doesn't pay for the construction cost. Yes, they pay first, but every cent of the cost is actually you as a consumer. We all get to pay for it. So when costs go up, it translates to higher per square feet, and the selling price is also locked in because that is the cost the developer has to pay. So if you add in land cost and then construction cost, the second point, the costs have been increasing for property developers. Point number 3, the new definition of GFA and why it affects you as a consumer. Now let's look at what URA has said about this specific topic. There is a new harmonized floor area definition. It's because the 4 main agencies, URA, SLA, BCA and SCDF itself, they have been using different floor area measurements for different purposes. For example, URA uses gross floor area GFA to measure building intensity. SLA uses strata area to demarcate ownership. BCA uses statistical gross floor area to measure the total floor area of a building, while SCDF uses accessible floor area. So each have their own pattern. The point of this harmonization is so that all 4 agencies are using the same, and from now on we are using the same GFA to compute things. It will make it easier for architects going forward and even owners to understand that instead of having 4 different agencies, 4 different dimensions, then we all using a standard dimension to calculate. So is it good for the industry? Yes, it is. Now let's look at what are the implications. So today, private roof terraces and private enclosed spaces are already computed as GFA to the developer. Under this new GFA definition, all uncovered areas that form part of the strata area of the development will be computed as GFA. For example, a lot of developers, how we used to do is this: balcony is bonus, but I can give you a large balcony, I sell you as strata area. I give you a large aircon ledge, I sell you as strata area. If you buy a strata landed, that car park lot that I assign you, I sell as your strata area. I make money out of that. I give you air space, double volume, loft units, very high ceiling. I sell you a loft unit, that extra square feet is actually sold to you as strata area, but under GFA is not computed. Right? That means you as a consumer, you're actually paying for a lot of extra spaces that is bonus to the developer, but can legally bill you because the authorities have not demarcated that as GFA. Now, with this new implementation, there are a lot of things that can no longer be considered as bonus spaces, and one of them is enclosed car park. That means if you have a strata landed, the car park last time not GFA, now it will be under GFA. If aircon ledge last time is bonus space to the developer, now as long as you want to sell strata, then you will actually have to compute the aircon ledge as GFA. So all these things, what does it do? It adds up. Easily your developer is losing maybe about 5% space. That means last time you don't have to compute aircon ledge and other spaces as GFA, but now he has to. So they're losing averagely about 5% or even more in terms of what can be built. So when a developer loses that space in GFA, that 5%, means I have to make it up somewhere. That means either my profit margin drop or I'm going to sell at a higher price. Whichever it is, the developer will not sell you something and lose money. Definitely, when the government implement this, it is good to streamline all the calculations. For example, they are now officially using the middle of the wall as a calculation. So you look at this example, this shows you something called curtain wall. Maybe you all go to a new development, you notice that there's always this ledge on the floor that you cannot use one. You cannot put anything one. It just makes it very difficult to use. But did you know that this curtain wall used to be bonus space? I can sell you the extra strata space. That means you actually are paying for the extra space, but at the end of the day, the developer is actually getting this as a bonus space. Cutting short, you are going to face that developers have less bonus space to play with. Costs definitely going to go up. So this will also affect how the developers going to price their units going forward. Fourth point, interest rate. This one very straightforward. You notice one thing, interest rates are all-time high. You as a consumer, you probably notice that your bank loans have become super expensive, increased by a few hundred to, I know some of my customers is few $1,000s per month. Now, imagine this, you only have borrowed $1 million, $2 million, $3 million. But what has a developer borrowed? Some will borrow the land cost itself. Some will actually borrow the construction. So all this is in the hundreds of millions of dollars. So you imagine them paying interest on few $100 million, and the interest payments, I tell you, a developer, the interest cost can kill you. That is why all developers want to sell their projects as fast as possible, because once sold, you can then have income coming in to your project account from the buyers that have bought, and as you reach certain construction stage, you will actually get money coming in. So the faster that you sell the development, your interest also will come down. So if interest rates are high, the only way I can cover the interest is by selling at a higher price. There is a certain risk the developer have to take. When I buy this, I expect to maybe have to pay interest for a good 4 to 5 years, from selling all the way until I TOP and I hand over. So with the increased interest rates, the risk is higher. I also have to factor in, as a developer, this cost into the consumer and the selling price. So this one is really unavoidable one, but it still would make developers think twice about which land they bid for, what is the chance of selling, and of course mega projects, the developers will be super scared right now. So if you are talking about en bloc of mega developments, not many developers have the guts to kind of take on this project and try to sell it in a market that we deem as, softening.